Were you imagining somebody in a suit? Or maybe somebody a little bit more clean cut? Not bad, but this is YouTube, so I'm gonna wear a t-shirt. That's better. And on top of that, I'll remind you to hit the like button, subscribe if you're not already, and leave me a comment down below. Now, with all of that out of the way, let's talk about the TFSA and why it can be one of the best ways to invest in Canada. The TFSA, or tax-free savings account, is a special investment account in Canada that lets you shelter your investments from tax, effectively letting you keep way more of your investment profits. This account is awesome. Honestly, everyone should have one. The account is so versatile and pretty easy to understand, which makes it great for a first investment account for beginners or even for experts too. So today I'm going to explain why you should have a TFSA, what it should be used for, the rules and misconceptions regarding one so you don't make any mistakes, and how you can actually open one for yourself. Now, the very first thing to understand about the TFSA is it is not a savings account. Even though in the name tax-free savings account, it really should be named the tax-free investment account. And that's because it's designed to hold investments inside of. I've actually started a petition here to change the name to the tax-free investment account. I only have one signature so far, and it is mine, but you know, if you just simply put money into a TFSA and don't do anything with it, it's just going to sit there and do nothing, like me on a Sunday afternoon. What? You need to actually purchase investments with the money you put inside the TFSA in order to unlock the special benefits that the account has. And what are those special benefits? Well, as I said earlier, the TFSA is a tax-sheltered account. So that means that it protects your investments from being taxed on their profits and on their income. Check it out. Okay, so we've got our TFSA here, and let's go ahead and put some money inside. Okay. And then let's buy ourselves an investment. Let's buy a stock. Oh, great. It looks like our stock generated us some profit. Uh-oh. There's a CRA. But don't worry, look. They can't get inside the account because it's a tax shelter. Why is holding investments inside of a tax shelter so important? Well, in Canada, any profits that you earn on an investment are called capital gains. So if you bought a stock for $10 and then sold it for $20, you'd have $10 of profit or $10 of capital gains. And while capital gains are taxed at a more favorable rate than normal income, it still kind of sucks to have to pay taxes on some profits that we made on our investments. Do you remember when you got your first paycheck and you saw the gross amount that you got paid and were all pumped because it looked like a nice big number? But then later on, you actually realized that there was an after-tax number that you actually got paid and it was quite a bit less. Well, in the tax-free savings account, we can avoid this. Imagine you got paid that total gross amount without having to pay taxes on that first paycheck. Well, that's basically what we can do inside of the tax-free savings account. Look at this example on my handy-dandy green screen. Okay, let's fire this thing up. Whoops, that's not right. Oh wow, apparently I'm a weatherman now. Today's forecast is cloudy with a chance of knowledge. That was so bad. Okay, there we go. So let's say we had two different individuals who are looking to invest their money for retirement. One person chose to put their money inside the tax-free savings account while the other person chose to put their money inside of just a regular taxable investment account. Now, upon time for them to retire and see how their investments did, they each both realized that they had both profited about $500,000. So that's pretty nice. Now, the person in the tax-free savings account can simply withdraw this entire $500,000 profit, and that's it. They get that $500,000. They don't have to pay taxes or anything. They just get the money. But the person who invested their money in the non-protected account, actually only gets to take out about $400,000, and that's because about $97,000 of that initial $500,000 profit is going to be going to taxes. That's about 20% of the entire profit that both investors made inside the account. Now, obviously this example is extremely simplistic, but it illustrates the main difference between a tax-sheltered account and a taxable account. So that's why it's great to use the TFSA as an investment account, because it protects you from having to pay those taxes on any of the profits that you generate from your investments inside the account. So now let's talk about what the TFSA should actually be used for. Since it's so versatile, it can actually be used for both short-term investments as well as long-term investments. This makes it great for people at all stages of their lives, whether you're somebody just getting started out or even if you're in the middle of your career earning tons of money. The flexibility and versatility of the account make it a great option as opposed to the RRSP, which can be a lot more restrictive and can only really benefit you in certain circumstances. Inside of the TFSA, you can hold all kinds of different things like stocks, bonds, mutual funds, ETFs, GICs, even high interest savings accounts. In fact, for short-term goals, like maybe you're saving for a down payment on a house in 5 years or something like that, a common practice is to actually open up a high interest savings account that's within a TFSA. And this is because it allows you to keep that money safe because you don't want to lose any of that principal with that short time frame. And at the same time, your investment is protected from tax. You don't have to pay taxes on that little bit of interest that you're generating for yourself. And then for long-term investments like saving for retirement, it's a common practice to hold a diversified mix of stocks and bonds inside of the TFSA. And this can be most easily accomplished through an index fund, which is something that I love and something that I'm going to teach to you in great depth on my channel. In fact, I'm planning on making a video dedicated completely to all the investment options that you have inside of the tax-free savings account and which ones you should choose based on your goals and risk tolerance and all that sort of stuff. The next thing we should address is how money going into and out of the TFSA works. And that's because the TFSA actually has a contribution limit and contribution room. And this basically means that there is a certain amount of money that you can put into the tax-free savings account before you run out of room. It's capped at a certain amount because otherwise everyone would just put all their money inside the account. And we can only shelter so much from taxes. Let me pull something up here on my phone to help you understand this better. So basically, the tax-free savings account was actually only introduced in 2009. So it's a pretty new account for Canada. So that means that the annual limit or the contribution limit for the year only started in 2009. And the way it works is that every year since 2009, that total contribution room has been increased by the contribution limit for the year. So we see that in 2009, the annual limit was $5,000, which means the total contribution room was $5,000. But then the next year in 2010, we got another $5,000 to be able to put into the tax-free savings account, which means the total room was $10,000. So that's basically the way it works all the way up until the year of 2020. And so you can see the total contribution room that you'd have in 2020 if you haven't contributed to your tax-free savings account at all yet. But another thing that's important to keep in mind is that it also depends on when you turned 18. When you turned 18, that's when your contribution room starts accruing. So you need to also pay attention to that too. And this nice little chart breaks that down for you. So you can look at your birth year and then you can see the total contribution room that you should have for your tax-free savings account. If you want to be super sure about how much room you have, you can actually log on to the MyCRA website, and if you go to your account on there, it'll actually tell you how much room you have in your tax-free savings account, in your RRSP, whatever registered accounts you have. You have all the detailed information there. But one thing to keep in mind is that this is only accurate for the previous year because they haven't gotten your information yet for the current year. So you need to keep track of what you've done in the current year And then you'll also have the accurate number as of last year from the MyCRA website. If you don't have an account on there yet, I would definitely recommend setting one up, because it gives you access to this kind of information and other really helpful information for everything to do with registered accounts, filing your taxes, tax returns, all that kind of stuff. A common misconception about the contribution limits in the room is that people see the contribution limit for the year. So for example, in 2020, that's going to be $6,000. And then they think that they can only contribute $6,000. But that might not actually be true, because if you have more total contribution room than the $6,000, then you can contribute up to that entire amount of room you have. If you had $50,000 worth of room, you can put 50 grand into the account, even though the contribution limit for the year is $6,000. That's just the new amount that gets added to the contribution room for the year. So it only really applies if you've already maxed out your tax-free savings account going into a new year. Now that we've talked about money going into the TFSA, let's talk about taking money out. So when you take money out of the tax-free savings account, first of all, you don't have to pay taxes on it. It's not treated as income, so that is awesome. And that's what makes it really flexible and versatile. And in addition to that, when you do take money out, the amount that you take out gets added back to your contribution room for the following year. So if I took out $10,000 in 2020, in 2021, I would get the $10,000 of contribution room back plus the limit for 2021 as well. So it could be something like $16,000 more of room. But the important thing to keep in mind is that if you take money out and then try and put it back in the same year, that can be a little bit dangerous, because the contribution room doesn't get added back until the following year. So if you've already maxed out your tax-free savings account in a given year, and then you try and take money out and then put it all back in the same year, it would actually get counted as you over contributing, because you've already maxed out your contribution room for the year, and it's not recorded again until the next year. And in this case, you'd actually get assessed a tax penalty. So you need to be very careful about what you do in any given current year, and making sure that you're keeping accurate track of how much money you're putting in and how much money you're taking out. So that's why it's very important that you respect this account and that you have a plan for using it. You need to make sure you have a goal and a timeline for that goal, and that you stick to it, respect it, and you have it all planned out so you don't run into any issues. And lastly, to open up a tax-free savings account, you actually have a lot of options. And that's because most financial institutions, if not all, should offer a tax-free savings account. Now, this variety of choice can make it a little bit dizzying to decide where you should open one up. So the advice that I would provide for you is that you need to determine what your needs are from a financial institution. Do you like physical locations, 24/7 phone support? Do you like to have access to more complex banking suites and online desktop app? Then maybe in this case, something like a major bank might be a good fit for you. There might be more fees involved because there's more services that they're offering you, but at the end of the day, peace of mind is also very important. Now, on the other hand, if you're somebody who prioritizes low-cost, simplified, and technology-driven solutions, then you might want to look at somebody like Questrade or Wealthsimple. There's not exactly a one-size-fits-all approach to investing, because everybody has different financial situations and needs. And this type of discussion really warrants its own dedicated video. So again, I'm going to be covering all these different financial institutions and what they can offer in several videos. Because fees play such an important role when it comes to investing, I want to make sure that you are as informed as you can possibly be before you set yourself up for the best future that you can have. The tax-free savings account can be one of the main things in your toolkit as a Canadian investor, and it can ultimately be the thing that allows you to achieve the life that you want to have. If you'd like to learn more about similar topics, as I said, there's going to be several that I'm covering that are related to this video. Please go ahead and subscribe to my channel. I'd love to have you as part of the community, and I'd love to help inform you more as you go about your Canadian investing journey. And with all that being said, thank you so much for watching, and I hope to see you again soon.